Hi, everybody. Good afternoon. Thank you so much for joining today's webinar. Maybe we'll give it another couple of minutes, wait to see if more people are joining in, and then we can begin. Can you all just give me a thumbs up in the chat box or a reaction if you can hear me, if I'm audible? Okay, perfect. Unfortunately, there's some issue with my laptop camera, so I will not be able to turn my video on, but I'm hoping this is going to be a good session. Okay, great. I think we can begin. Thank you all so much once again for joining me on a Saturday afternoon for this webinar for ithoughtmfd. What we're going to be discussing today is how we can practice asset allocation using mutual funds, right? We have various categories of mutual funds. We have equity, we have debt, we have ETFs. How do we participate in precious metals using equity funds? So all of those aspects we're going to be discussing in today's webinar. Before we look at how we can do asset allocation and what actually goes into the thought process behind an asset allocation investing, first we look at what investors actually focus on and what actually matters, right? So investors are predominantly, worried about timing the market. So entering the market at the right time, uh, harping on the next multi-bagger or looking for the next biggest performer and, not staying invested or constantly jumping the gun. They're looking for complexity and sophistication. When you start investing, what actually happens is we get caught up in the whole excitement of making money, and we make the whole process very complex and difficult for us to understand ourselves. And what happens in the process is that we sort of lose sight of where we actually want to be. And then always wanting performance and looking at what the benchmark is doing. Am I doing better than the benchmark? Am I doing lower than the benchmark? So we get caught up in a lot of these things and we lose sight of what actually matters, right? What actually matters is systematic participation. First of all, how much ever volatility there is in the market, because we can't rule out the volatility factor when we are investing. The markets will go up, the markets will go down. There is going to be movement. But what is important is to stay invested and constantly participate, right? Asset allocation comes next. Instead of putting all your bets into just one basket, it is always better to put um, your eggs in multiple baskets, right? So you have some equity, you have some debt, you have some exposure to precious metals, you have some real estate, you have index funds or other passive modes of investing, right? So you systematically participate, and you systematically participate in those asset classes at that point in time that are performing well. So what is doing well, then you will add more money and you let the rest of it stay. You stay invested in the rest of it. You don't pull out of it, right? And you choose simple financial products. You don't want to get into things that you don't even understand in the first place, right? What happens when you go and put your money in things that you don't understand is you get very restless about not making money. And what happens in the process is that we either end up very disheartened about the fact that we've made losses and, I'm not a good investor. You come to all sorts of conclusions because of the fact that you don't understand what you're getting into. That is very important. You have to always, even if you're doing investments on your own, it is very important to sort of understand what you're getting yourself into. This is what an advisor can actually help you with, right? When you're working with an advisor, they will tell you what actually suits you, what will fit best for your your kind of investor profile, what is your risk score, what kind of risks will you be able to take. They judge your abilities based on the kind of investor that you are, and they will help you understand what works best for you. And in the process, you will be able to invest in those things that you actually understand, and you will gain more knowledge in the process as well. And what again matters is consistent compounding. So you keep putting money and your money makes money for you. This is a primary aspect of investing. Compounding is what makes investing exciting, right? But you see compounding only in the longer term time frame. You can't put your money today and expect that it would have compounded threefold or tenfold tomorrow. You have to give it, at least 3 years or 5 years for it to make money for you. And from there, it just compounds faster. Time does its work for you. Once you've put your money in an investment, what you do is you regularly review it, you rebalance it and all of that. But at some stage, you also end up not neglecting. It's a good way to just invest and forget, because that way you're not always harping on, oh my God, how my investment's doing? Do I have to constantly watch it? How long or how often do I have to review my portfolio? This is an anxiety that we see across investors, and focusing on these four simple things is what actually matters in an investment journey. So now let's slowly move into the concept of asset allocation. I use a very easy example. There is a question in the for debt allocation, which scheme is suitable? So right now, it will be best to look at, the gilt category or the corporate bond category, considering how much volatility there is. So you may want to, check those products out and see how they will best fit you, right? So now let's begin by thinking of asset allocation the same way a coach would think of a football team formation, right? So imagine a team that's ahead in the game. they may want to go defensive to protect their lead. So, and now think of a team that's trailing behind. That's, they're struggling to make points. They need to make more, they need to pave more way for them to take more risks and go on the attack mode. And just like this, your investments also need a structure. It needs a formation that suits your goals, your lifestyle, and your risk appetite. You can't be aggressive all the time, and nor can you be defensive forever, right? So the way you allocate your money across equity, debt, gold, or liquid funds basically determines whether you're on track to meet your goals or not. And the whole process of asset allocation, it's not just about picking the best performing fund. It's about choosing the right mix for you for where you are and where you want to go. Right. So think of this as a strategy, sort of strategy meeting for your personal finances. Right. The asset allocation mix will not be the same for every investor. It's not one size fits all process, right? It will be different for different individuals because they're all in different stages of life. You all have different risk appetites. Your investment allocation would not have been the same when you were 20 as opposed to what you're now, right? So these are things that you have to keep in mind and constantly review. It is very important to have a well allocated portfolio. So basically in this slide, what we're going to look at is, see, if you are planning to split your investments across various baskets, right? First, you have to decide how much you want to save, because only then you will be able to invest. And then you have to arrive at how much you can afford to spend at the end of it, right? So keeping this in mind, this slide basically breaks down the different asset classes and what role each of it plays in your portfolio. Let's start with cash, right? This is something that we all like to see also. So things like savings account, liquid funds, or short-term debt funds is what comprises of cash or cash equivalents. And their main function, their main job is liquidity, to be able to withdraw whenever you want to and to be able to have that amount of cash to be able to spend, right? It is often misunderstood for emergency reserve, but you should have a separate emergency reserve and not just rely on these. See, liquid funds, you predominantly put money in liquid funds to be your emergency reserve. And it is good to have 6 to 9 months worth of emergency reserve, right? So people often say, or they feel that they're safe, but they usually don't beat inflation. So the role of cash is to not grow your money, but more importantly, to be available when you need it for emergency or short-term needs. That actually comprises of your emergency reserve. So whenever there's an emergency, you should be able to provide for it. It should not come to a point where you have to go into your investments or pull out of your equity mutual funds to be able to provide for those emergencies, which is why it is very important to have an emergency reserve of your own and not dip into your other savings or other investments, right? And then there is debt, which basically provides stability. It generates a fixed income. It sort of smoothens your ride when equity markets are volatile, which is what is happening right now in today's market. A lot of people are parking their money in debt. Of course, it's a good idea right now because the markets are very volatile and there needs to be a certain level of stability and protection that needs to be given to the portfolio. And as and when opportunity arises, we can always move that money back into equity. But what happens is people usually think it's boring or, very low returns. But what it does is it provides you that safety net. Equity, on the other hand, it helps you grow your wealth and beat inflation over time. But it comes with volatility. But that's the nature of equity. And then we have gold. It works as a hedge. It's a precious metal investment, gold, silver, and all of that. It works as a hedge, especially in uncertain times. It protects your purchasing power, how much you will be able to purchase, right? It doesn't generate as much income, but it definitely does store value. You must have read in multiple places that gold is a store of value. And the amount of your allocation towards gold will depend on your goals only. If you're closer to retirement, you might want more debt and less equity. If you're in your, say, 30s with long-term goals, a higher equity allocation could be better. So basically, this table acts as a blueprint for you. You understand what each asset brings and what it doesn't, and how much of it you really need. Right. And then the next step would be to classify all your expenses. Right. First, you sort of decide how much you want to save. Then you arrive at how much you can afford. Third, you classify your expenses. So essentials, your rent, your utilities, groceries, etc. And then there's fixed expenses that comes in the form of maintenance, insurance, loans. And then there's discretionary expenses that is up to you, right? Your entertainment, travel, shopping, and what you spend for yourself. Once you classify your expenses from those baskets, you identify your priorities. What is of paramount importance is what I will spend on right now, and what can wait, I will do it later. So you become a smart spender. Don't be impulsive. You have to plan for bigger expenses and take advantage of those discounts and offers, right? And then you review and revise your budget and always keep a buffer of 5 to 10% in cash. If you practice all of this while going through your investment journey, you will be very happy and content with where you are, and you will also be very happy with the kind of money that you're making. I am getting quite a few questions. What I will do is you can list your questions down in the chat box. I will take it towards the end of the session. Okay, now let's come to the 3 buckets of goals that we have: short-term goals, medium-term goals, and long-term goals. Let's bring this to life. Think of real goals, right? You're saving for a vacation, you're buying a house, getting a new car, or planning for retirement. Each of these goals, if you've paid enough attention, each goal has a timeline. It has a priority and a risk tolerance attached. So for example, say you're saving for a vacation that you want to go on in 6 months. You don't want to invest in equity, so you go for liquid or ultra short-term funds. But for retirement, that's say 25, 30 years away, liquid is not going to do the job for you. Equity is your best friend. So what is important to understand here is that asset allocation is really about goal mapping. So you first define what the goal is. Next, you give it a time horizon, and then you choose the right mix of assets that you want to be able to achieve that goal. You don't invest blindly. That is very important to remember. Don't go invest blindly if you don't know what you actually want out of it at the end of it, right? If every rupee has a purpose, every investment will be intentional. This should be like a key takeaway for you from this slide. If every rupee has a purpose, every investment will be intentional. So what this slide essentially encourages you to do is to think about why you're investing. Because only when that becomes clear, the how to invest, the next step becomes easier for you. Only if you know why you're investing, only if you have a goal, you will be able to think of various ways and various vehicles that you can use to actually be able to achieve that goal, right? Otherwise, you're going to lose sight of why you're doing things, right? You'll get caught in the quagmire of absolute so much confusion. You will not be clear about anything. So in order to avoid yourself that trouble, you should be in a position to first think about why you're investing, and then the rest of the steps that follow become easier for you. Okay, so now that you've understood what asset allocation is and how you can actually practice this process, let's say you started with a 60 to 40 equity to debt portfolio, right? Now, after a market rally, equity grows and becomes 75% of your portfolio. Now, what happens? That 60% has gone to 75. So naturally, your risk exposure has silently gone upwards. Now, that is why rebalancing your portfolio matters. Why? It brings your portfolio back to its sort of original formation, which is the one that you were initially comfortable with. When your risk exposure in the portfolio goes up, you're naturally going to get a little bit restless. So you might want to restructure your investments or rebalance. That's what we call rebalancing and reviewing, to bring it back to its original structure. And what happens when you're rebalancing, right? It helps you book profits. So when an asset class runs ahead and buy more when something is available at a discount, right? It keeps the greed and the fear factors in check. So the first why of rebalancing is for risk control. The second is discipline. And the third, it automatically creates a system where you buy low and sell high. So rebalancing also shows that you're in control. It goes hand in hand with the discipline. What it means that you're not reacting emotionally to markets. You respond rationally, and that is what smart investing looks like. But now that we know why rebalancing is important, right? You need to rebalance because you have to protect your profits. You should be able to capture new opportunities while also keeping in check your risk appetite and the structure of your portfolio, just to make sure that it is where you need it to be. And it also keeps you disciplined. You have to review your portfolio, say quarterly or every 6 months, just to see where you stand. That sort of brings in that discipline in you as an investor. But when do you have to rebalance? That's the next question. So there are two common approaches that investors use. One is time-based. Like I said, once a year or every 6 months or every quarter. And the other is threshold-based, which is target-based, where you act on your portfolio only if your asset allocation drifts more than 5 to 10% from your target. If it has fallen 5 to 10% below what you expected or gone up, then you actually have to review it to see what has worked, what has not worked, and see where you can make that small change. Both of it works, but in the end, like we all know in investing, consistency is what matters. If you review, say, once a year, just make it a part of your sort of financial calendar, like a health checkup or your, you might have your annual temple visits and all of that. So make it part of your financial calendar. Just put it on your calendar and say, this is the day that I will be reviewing my portfolio every year, with my advisor, or I just want to see where I stand as an investor. And remember one thing, that rebalancing, it's not about chasing performance. Again and again, I'm reiterating the fact that rebalancing is not about chasing performance. And asset allocation in itself is not about chasing performance. It's about staying true to your original plan. It helps you keep yourself in check and on track to see if you're on the right path to achieve the goal that you had initially envisioned when you started your investments. And also, you don't have to do it manually if it feels very overwhelming. There are many platforms, there are many advisors that offer tools or models, which makes the whole process automate for you, right? So the key is to be aware and not let your portfolio drift too far off course. So now you know why you have to rebalance, when you can possibly rebalance. Next question is, how often do you rebalance? So ideally, at least once a year, but if there's a big life event, like a job change or a wedding, or, say buying a house or a big market movement that has affected the portfolio left, right, and center, then it's worth taking another look within those 6 months itself, right? So if your goals are long-term and your allocation is balanced, then you don't need to rebalance every month. So like we know, too much tinkering also creates that level of anxiety, and sometimes it creates the tax liability also that you don't want to tread on. Just keep it simple. Review once or twice a year. Let your investments do all the heavy lifting in the background. You've done the heavy lifting in terms of taking the big decision to actually think of why you want to invest and how you want to do it. And once you've put your money, you just let the investments do all of the heavy lifting. Right. And think of it like an example that I can give you is maybe gardening. Think of it like gardening. So you don't dig up the soil every day, right? You water, you observe, and you see, and you prune when required, and you trust the process. The same goes for investments. The same goes for asset allocation. Just give it time, but give it a check once in a while. But this is a very, very crucial message. What works for you might not work for others. Everyone's life is different. Income, expenses, goals, responsibilities, risk appetite. So naturally, your investment strategy has to be unique as well. Just because somebody you know is investing 90% in equity doesn't mean it's right for you. Or just because someone older than you is holding a lot of gold does not mean that you should. Your portfolio and your statement should be, it should be a reflection of your journey in itself, right? So that's why blindly copying portfolios or reacting to social media trends can be very, very dangerous. Because just taking a consensus driven approach has never worked for any investor, right? And we're not investing in just mutual funds. What we're doing here is we're essentially investing in our future. And that future is very personal. So you don't want to uh, play around too much with it. So you take advice, you do your due diligence and research, but you always come back to what suits your life and your investment ideas the best. You might want to take inputs and opinions from everywhere, but at the end of it, be able to form your own, because at the end of the day, these are your investments and these are your goals that you want to achieve. How do you make this sort of, uh, you know, multi-asset work for you? Right. So when you're building a portfolio of investments, right, it's not just a bunch of any random investments. It is a rather carefully built combination where each fund or each asset class plays a specific role. You might have large cap equity funds for stability, mid cap or small caps for growth, debt funds for safety, and maybe a little bit of gold for diversification and hedge. Right. So what this slide encourages you to see, what I would like all of you to see in this portfolio is, in this slide, is look at this portfolio as a team where everyone has a job. You don't overcrowd your portfolio with too many funds doing the same thing, because that in the end it leads to clutter and not diversification. We all know, we've heard the saying, too many cooks spoil the broth. And also make sure that your portfolio evolves with time. What worked 5 years ago will definitely not work today. So you use all your rebalancing and your reviews to gradually refine your mix. And the concept of investing is that less is more, but it should be very meaningful. Right? The idea is very simple. You don't put all your eggs in one basket, because if one asset class performs, another asset class that is in the portfolio will support the portfolio. And there are mutual funds today that do this for you. There are multi-asset funds or hybrid funds, and there are various options that you have. And remember that no one asset class performs the best every year. That is why I wanted to do this webinar, to sort of make everybody understand the importance of a balanced asset allocated approach, because it can deliver more stable returns over time. And this also more importantly, it helps to reduce the anxiety during market corrections and creates a more smooth journey for your investments. Right. So to take action, first, you set clear investment goals. You understand your risk tolerance and start small. Be consistent. Take one step at a time and build your emergency fund first, and then you choose the right investment platform and you go ahead, monitor and adjust your investments once you've started it, right? It all brings us here to the actionables, right? Motivation might have brought you to this session, but discipline is what it'll take for you to reach your goals. And while you are actioning it out, you should also know that asset allocation is not a one-time act. It's an ongoing practice, and every small action that you take, it builds up over time. So don't wait for the perfect moment. Don't harp on those things that are not in your control. Just be consistent. You start now, you start small, but you stay consistent. You don't necessarily need to be an expert to succeed at investing. You just need clarity, you need patience, and the right guidance, right? And that's why we're here to help you every step of the way. We've helped Hundreds of investors reach their first crore with just an asset allocated approach towards mutual fund investing. So that brings me to the end of the webinar. I hope it has been a useful session. If you have any questions, I will be more than happy to take it. You can put your questions in the chat box and I can take them one by one. In the meantime, I'm also putting up our contact details, number. You have our website link and also our email. You can feel free to write to us or call us at any time that you want to. You can also follow us on social media. We keep posting a lot of content. We will be more than happy to help all of you to, sort of start your investment journey or make it a little better for you. Okay, so there's a question. Given the current uncertainty in the global markets, will it be wise to a partially book profit equity? Okay, so what would be wise? Again, it depends on what sort of an investor you are, but it is a good time to sort of park some money in debt, right? You don't have to reduce your exposure to equity. It depends on what sectors of the equity market you're in. Right now, the sectors that are looking attractive are predominantly, I mean, large caps for sure. And then there's FMCG that is doing well. So you may want to take a look at that as well. There's banking that's doing well. Right. So you may want to stay participated in these pockets of the market, but also increase your exposure to debt. And wherever you can book profits, you can in stocks and move that to mutual funds, right? Medium-term goal. Medium-term goal, where can we invest and how to choose the right investment platform. How do you choose the right investment platform is, I mean, you have to, for you to be able to do that, you should actually know what you're investing for. If you, takes me back to this slide, right? The step of choosing the right investment platform comes after 4 steps, right? And if you actually need advice, you will have to speak or do your due diligence in terms of research, because now we see a lot of scams that are happening and there's a lot of fraudulent activities that's taking place. So you have to be very careful with who you're reaching out to and think twice before you put your money with such online platforms. So it's always, you have platforms like Grow, Zerodha, and all of that that's doing the job for you. Right. So you may want to do your due diligence. How much ever we tell you that, this is the right platform, it is important for you to do your research before you actually put in your money. So for a medium-term goal, where can you invest? Again, it depends on the goal. It is good to put your money in, equity itself. We can put it in, say, a large cap equity fund, give it maybe one thematic or one multi-asset fund. How much allocation to crypto? That's actually a very interesting question. I'm not too sure about what will be the right allocation to crypto. I will definitely get back to you on this question, sir. Given the volatility, being an aggressive investor, it does not matter whether the international markets are more rewarding or the Indian markets are more rewarding, right? At the end of the day, there is a sort of snowballing effect that happens. We have no idea what Trump's next move is going to be, and that is already shaking the Indian markets a lot, right? And this year is going to be a year of maybe no returns, which is what we're communicating to a lot of our clients. given that you're an aggressive investor, you should just stay put and yeah, I think that's what would be best. The international markets are also booming. We recently had the Fed meeting, and they also sort of remained their, sort of retained their rate cut. They did not do any rate cuts. They kept it steady. It's 80% equity allocation. Okay, that's right. Correct. So for this current market situation, we're not heavily skewing towards equity. We're only participating in those portions of the equity market that are favorable for us. We are parking enough money in debt for all of our clients to provide that safety net. It is only when the opportunity arises that we're proposing higher equity allocation. Otherwise, if there is no opportunity, then we will have to have some way to keep the portfolio stable, right? Which is why right now in this market scenario, we are allocating money towards debt. It's not always an 80% equity allocation, and it's not across clients also. I'm not sure which part of the slide said 80% equity allocation, sir, but okay, this one. Up to 80%. See, again, it again depends on which cycle of the market you're in. This is not like a one size fit all approach. It can be, if you're an aggressive investor, you can have 80% of your portfolio in equity. There's nothing wrong with it. But this is what we've seen across the board, and I prepared the slide based on the general scenario. This is not specific to anybody. Investments and asset allocation depends on what cycle of the market you're in. Gilt versus short. It depends on which cycle. Again, so gilt is more, it takes a longer duration call, whereas the short-term debt funds, or even a 5-year gilt for that matter, it takes a shorter duration. All right, so we'll keep that in mind. What I'll do is I'll change or phrase the way that this slide has been made, and then maybe. But thank you so much for pointing this out. I will definitely make the change in the presentation. So right now, I think gilt, the 30-year bond looks 30 or the 10-year segment looks attractive. So that should be a good allocation towards debt. Because the longer the duration, the less sensitive it is, right, to all of the macro changes that is taking place. So you can go ahead and invest in longer term or longer duration bonds. We are a value and growth based organization, and we are very contra in our investment approach as well. It's not just these markets, sir. It gets affected by other markets as well. But with the volatility that we see in the US market, now we're able to witness firsthand the volatility in the Indian markets also. Because the first indicator of that is the currency appreciation or depreciation. Yes, sir, correct. We are not shaped only by how US is performing. I agree. Yes, sir. That's very true. We're very influenced by it. Definitely, sir. You can. You should reinvest in mutual funds. It's a good time to reinvest in debt, mutual funds. Should we to add some examples of simple cases? Sure, sir. I will keep that in mind for my next presentation, and I will ensure to add more simple case studies for you. It definitely is, sir, because when too many people are flocking towards the same thing and there's lots of money going into it, there will come a point where everything will dip, right? Which is why diversification becomes a very important part in your journey of investing. But that's what we are trying to do for all our investors, sir. We follow the practice of asset allocation even in mutual funds for all our investors. But as you rightly pointed out, maybe a lot of them are not following it in, outside. So which is why I wanted to take this opportunity to sort of educate people on how important it is to have such an approach towards investing. Is asset allocation applicable to individual? No, so the process of asset allocation will be different for every investor. It won't be the same mix for everybody. No, first we have to pay attention to the allocation at the individual level or the individual portfolio, and then we have to look at the I thought level, right? It's not a one size fits all approach. Once again, I'm re-emphasizing on this. It will be different for every investor. It all depends on your risk score, what your goal is, and what time frame you want to stay invested for. It's not going to be the same in every portfolio. Great. If we know yes, silver and gold still look attractive, can continue investment. So we are very bullish on gold as investment category. Silver recently hit all-time highs also. We want to consider that as well. So, no, there are not other precious metals that we're looking at as an investment option apart from gold and silver for the time being. All right, great. If you have no further questions, I will end the webinar here. Again, I've put our contact details in the slide. Please feel free to contact us at any time. We will be very happy to help you in your investing journey. We will be very happy to have a conversation with you as well. And don't forget to follow us on social media. We post a lot of content. Thank you once again for joining me on a Saturday afternoon for this webinar. We hope you enjoyed it and it was informative. Hope to see you in all our upcoming webinars as well. Thank you. Thank you so much, everybody, and have a great weekend ahead.